You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Alan, wonderful to be back with you this week. How are you doing? How is Dublin treating you at the moment?
Very, very good. Good to be back. Lovely sunny Friday here in Dublin, and looking forward to more Rugby World Cup at the moment. So that's the big focus outside of the Federal Reserve and the volatility in markets.
Absolutely. Hopefully in that order, I imagine. All right. Well, we have, thanks to you, a very solid lineup, I have to say, of topics that we will be tackling today. But as you know, before we do, I'm always curious to know, kind of a little bit outside the topics we're going to talk about, what's been on your radar the last few weeks since we last spoke?
Yeah, I guess we'll get into it in terms of the kind of bond market and treasuries, etc. But it is interesting how there's been a couple of articles out in the last while talking about the concerns around the treasury market again and the basis trade, and the BIS highlighting that the magnitude of that trade, was basically I think it's long cash treasury securities short the futures, and this was a trade that effectively almost blew up in March 2020, and the Fed had to intervene. But obviously we've seen lots of money flowing into these multi-manager platforms, and this type of trade seems to be very popular in that cohort. So interesting. There was also an article about leverage more generally in the market. So just interesting how there is this concern about what we're seeing in terms of the amount of risk taking out there and potential spillovers, something that maybe we hadn't seen for a while, but certainly something I'm focusing a little bit more on at the moment.
Yeah, I know we're going to jump in to kind of your big macro view right now framework, but I was wondering, this, of course, has been a week that I think in fairness has been focused on Jerome Powell and what he had to say about the outlook of interest rates. But I was kind of wondering, what if the Fed was wrong when they said that inflation was transitory, and it turns out that the current deflationary pressures are transitory? What do you make of that?
Yeah, it's possible, I guess. As in everything in the markets and economics, you've got different viewpoints. We've already had significant disinflation on the manufacturing goods side. So you might say, well, maybe a lot of that has already run its course, and maybe from here is a risk to the upside. And obviously we've had energy prices moving up as well in the last while, and there's concerns around food prices and weather-related concerns. We're in an El Nino this year, etc. So there are reasons for being cautious. Equally, we might talk about some of the guests we've spoken to on the global macro. Chen Zhao was one, and he was making the point, well, we've already had a big fall in inflation, but we might not have seen the impact of monetary tightening yet. So if you took that perspective, and we did see the slowdown to come, then we might see an even bigger fall in inflation. That was his viewpoint. So I don't know. Who knows? You can make arguments on both sides. I think probably a safe assumption is probably greater volatility of inflation rates over the next number of years than we've seen, certainly in the last decade, which in itself would be influential on markets. Going back in time, Jeremy Grantham at GMO had a model that kind of modeled the level of PE ratios for the US market. And a key input of that was not just the inflation rate, but the level of inflation volatility, with higher inflation volatility generally associated with lower multiples. So I think that would seem a reasonable assumption. But whether you're in the disinflationary or the resurgence of inflationary camp, you can make arguments on both sides.
Well, at least that's why there are markets, right? There needs to be people believing in both sides of the argument in order to trade. So I guess that's fine. we're going to stay with macro for a while in the first topic that we're going to be debating. But before we do that, I thought I would just run through a few things that is going on in the trend following space, so to speak. We are kind of 3/4 through August. So far, so good, I would say. Looking at the markets, I mean, just from a the last week or so, I mean, kind of the same themes. Bonds been on a lot of pressure. T-bonds down 2 big figures since last week. But then also, of course, the equities have come down quite a bit. And I think, energies have given up a little bit of their gains, at least some of the markets, as far as I can tell. But from a trend following performance, it has been fairly good so far. But if we look at the kind of the attributions, I would say the downside, definitely equities taking a breather and therefore been putting a bit of pressure in terms of giving up open profits for trend followers. Currencies could have been a little bit tricky, depending on your kind of weights. Mexican peso, which has been a good trend, came off this week. British pounds have been selling off. So, depending on your system speed, they could have been causing a little bit of downside pressure. But on the other side, the positive side, and I think these are pretty strong sectors for many trend followers, it's the fixed income markets, first and foremost. I think the continued sell-off, given what's coming out of the Fed at the moment, has certainly helped trend followers. As I expect, most of them are still short. But then also energies have done pretty nicely. And of course, this is because of the higher prices that we're seeing at the moment. Grains have done okay as prices continue to slide. So that's not where the inflation is coming from at the moment. But actually, live cattle, for those who are interested in prices of meat, is having a pretty strong uptrend at the moment, as is orange juice and sugar. My own trend barometer has finally moved a little bit higher. It's, I wouldn't say a breakout, but it's at 52. So it could be a little bit interesting and exciting for trend followers from a performance perspective. In terms of numbers, as of Wednesday, Beta 50 index up 2.44 for the month, up 2.07 for the year. SocGen CTA up 2.79, pretty strong, up 1.18 for the year. SocGen Trend up 3%, up 60 basis points for the year. And the short-term traders index up about 1% for August, down 2.4% for the year. In terms of equities and bonds, MSCI World down 3.35% for the month, but still up 10.89% for the year. World government bonds, as mentioned, having a rough time, down 1.53% yet again in August. And the S&P 500 is down almost 4%, but still up almost 13% for the year. All right, Alan. Now, it hasn't been that long, but it was in August. There was a little get-together in the Midwest, in Jackson Hole to be precise. And one of your guests that has been on the podcast, Barry Eichengreen, was commissioned back in February to produce a paper for the Jackson Hole conference to present and discuss it with the heads of central bank. I think the paper was called Living with High Public Debt. And I think their thesis is that high public debts are not going to decline significantly in the foreseeable future, and countries are going to have to live with the new reality as a semi-permanent state of affairs. These are not normative statements, these of what is desirable. They are positive statements of what is likely according to their paper. So take us into to this debate and kind of your thoughts on this.
Sure. Yeah, I mean, I think this is interesting. The topic is interesting in itself from the perspective that, the whole point on Jackson Hole is it gets together, key policymakers and economists to talk about what they perceive to be the most topical point of issues of today. So the very fact that policymakers are talking about high debt levels and looking for guidance from people like Barry Eichengreen, who's written a book on public debt, but he's also an economic historian. So he's well placed to comment on, the trajectory of debt in a historical context. So the fact that they're focused on this at the moment is telling in itself. And particularly, I guess, from the perspective of, it's been interest rates, bonds that have been the key move in markets. The 10-year yields up to 4.5% in the US just this week, the highest level since 2007. So 16 years ago, would you believe? So it is quite significant that we're seeing these shifts back to what I suppose people of our generation would probably call just more normal levels of yields. But for anybody who kind of came into the markets after the financial crisis, no doubt seemed like very high levels of yields. And the point of Barry Eichengreen's paper is to look at the current trends in debt levels and understand what's driven them. They also talk about the holders of debt and how that's shifted over time, and then also to make observations around can debts be reduced at all, or is that likely, and how is this likely to play out over time? And specifically, they talk about conditions for debt sustainability, which I think is going to be something that we're going to hear a lot more of in the next while now, because rates are moving up, and because we've already had a surge of indebtedness and large budget deficits over the last number of years. So in terms of some of the interesting points to make, if you were to look across the advanced economies, broadly speaking, debt to GDP levels were pretty stable prior to the global financial crisis. In some countries, it come down and might have been somewhere in the region of kind of 40 to 60%. But since then, we had a global financial crisis and the policy response after it. Then we had a period of, back in the 2010s, austerity was to the fore. That whole philosophy, you might remember, there was the paper from Rogoff and Reinhardt where they had an error in their spreadsheet, but notwithstanding that, the view was that once debt to GDP gets above 90%, it can be problematic. So the general economic thinking of the time was, austerity was a good thing and necessary. So debt to GDP levels were broadly stable, I would have said, through the decade. But then obviously what you did have was very low interest rates. So people started to say, well, debt is manageable. It doesn't really matters. And, having these very high debt levels. And of course, we had the emergence of modern monetary theory at the time, and which you don't hear a whole lot about these days, funnily enough. And then a big surge of spending post-COVID and a jump up in debt levels again. And in the US now, the debt to GDP level is about, I think it's 120% of GDP, but 20% of that is held by federal agencies. So debt in the hands of the public is about 100% of GDP. The question is this here to stay? Are we likely to see these debt levels come down? And what are the implications? And they look at kind of historical episodes of how high debt to GDP levels get addressed, or have they have them historically. And they take a very long-term perspective. They look back through centuries. And what you tend to find is debt levels tended to historically to jump up when countries went to war. So the US after the Civil War, Britain after the French and Napoleonic Wars, France after the Franco-Prussian War. And back in those days, they did tend to then run budget surpluses to bring the debt to GDP levels back in line. The point from Eichengreen is that that's unlikely in the current environment. This was all back in the Victorian era of sound finance, as to point out. But that was before, politically it was difficult to pull back. There was no welfare state back in those days. So they were saying, it wouldn't be, in the current political environment, it's hard to see us back to an environment where governments are going to start running primary fiscal surpluses on an ongoing basis, particularly when you look at the US at the moment, where the economy is very strong and they're still running a big budget deficit, which is not what you expect. You expect fiscal revenues to be strong when the economy is strong. So in terms of the mechanisms to address debt, running a surplus is one. They say that's unlikely. The second typical way you might try and address high debt levels, and you hear this from a lot of commentators, is financial repression. So basically, you kind of force savers to buy bonds or accept a lower rate of interest than kind of the market rate. So that can be, either manipulating interest rates via QE, but forcing, say, post offices, etc., to buy bonds, or banks to buy bonds, or else putting caps on deposit rates, like back in the US in the 1960s, 70s, early 80s. I think they had Regulation Q, which capped interest rates. Again, the point about this is that the environment was different then. It may be more difficult politically to do this now. So they're skeptical on the ability of financial repression. The third way you can address high debt is through higher inflation. And you often hear this, that you can inflate away the debt, and maybe the central banks are happy to have higher inflation just to allow that. And again, they're kind of skeptical of this point as well, from the perspective of, they point out that it's generally unanticipated inflation that will do that for you. So if you get a surprise of inflation like we've had in the last couple of years, that can be helpful in bringing down the debt, because your debt to GDP level, the GDP side is increased in nominal terms by the higher inflation. But if you get persistently high inflation, then interest rates will factor that in, so your debt service costs rise. So again, they're kind of skeptical on the ability of higher inflation to be used to address high debt levels. So in sum, they're kind of saying that high debt levels are here to stay for all of those reasons. An important point around this, though, is what level of debt and deficits are sustainable, or where does it become unsustainable. And they talk about this relationship R minus G, which is something you hear economists talk about all the time. Well, economists who focus on this issue. And R is the real interest rate, and G is the real growth rate. And basically, what you want to have for greater debt sustainability is higher growth relative to the interest rate, because if you're growing strongly, you're going to generate more fiscal revenues, and that will cover your debt service costs. Whereas on the other hand, if interest rates are too high and your growth level is too low, you're going to be generally, the value of the debt is going to be increasing over time, because your fiscal revenues are growing slower than your debt service costs. So R minus G is really important. And they run some calculations and point out, for the US at the moment, with a debt to GDP level of 100%, the numbers are very easy to show that basically you need a primary deficit of 1% is okay. That's sustainable over time. But the problem is, at the moment, the primary deficit for 2023 is projected to be 2.9% in an economy that's already very strong. So without anything else, the US should be trying to fiscally consolidate at the moment. But that would be proven even more challenging, say, if we went into a recession, because, you're going to have more spending and less revenues, and you tend to see your budget increase over time. That's not to say it's going to spiral out of control, but that does highlight the fact that the trajectory is on a negative path at the moment. We're nowhere close to the kind of variables that you would like to see to get to sustainability, and you already have a high level of stock of debt. So it's all very significant from that perspective. And I think that's partially why we're seeing the move in treasuries that we're seeing this week. It's that this is a factor that people are starting to focus in on to a greater extent. For example, if you look at US treasuries and you look at the term premium for 10-year bonds, so that's the difference between the return you get on the 10-year bond versus if you just rolled T-bills for 10 years. And normally you would expect there to be a positive term premium reflecting the volatility of holding the bond. Actually, it's been negative for a number of years. I think that's related to QE and people, a scarcity of bonds. But that's starting to shift now. The term premium has gone from negative to positive, and people are saying, well, ordinarily you might expect it to be positive 50 basis points or 1%. But again, that's reflecting maybe people starting to reassess the safety of the asset and this term premium being built in. And of course, the problem with that is at higher level of yields, the numbers become self-reinforcing in a negative sense, because the higher rate means your debt service costs increase, etc. So it becomes a vicious cycle. So it's not into a negative spiral by any means at the moment, but certainly the trajectory of travel is negative.
Yeah, that was a great recap. Of course, when you hear all of this, and I completely agree with you, I think that even though actually, and I will applaud Jerome Powell for that particular point, and that he's been pretty consistent in his messaging the last, 12 months or so, in terms of higher for longer and all of that. And now, of course, the debt looks like it's going to be higher for longer, according to Barry. But you do wonder why investors haven't wanted a higher premium for buying long-term debt. And of course, it makes it even more inconceivable why people in Europe bought 100-year bonds at zero interest rate, or maybe even, I don't think it went negative, but the 100-year bond was not very positive in terms of the yield. And you just think that is absolutely crazy. So interesting. Now, you've had some really interesting conversations on the podcast lately, and also going back a little bit further, I remember your conversation with Bill White, but more recently, of course, David Rosenberg and Chen Zhao. What are their kind of, or are they, I feel I remember that they had kind of different views on these type of issues.
No, absolutely. And I think this is one of the points where people do have different views. I mean, if you go back to the Bill White conversation, which was probably around this time last year, it was more around not so much debt sustainability, but kind of, you know, I suppose the dollar's reserve status and the attraction of US as a destination for investors. And will that be, you know, obviously the consensus view is the US preeminence is here to stay, but what would change that? And that might be around things like the trajectory of debt or the debt ceiling negotiations, that type of thing. I think a lot of, as I've been talking about this relationship between interest rates and GDP, and we're talking about this on a kind of a long-term basis as opposed to the kind of where the Fed funds is at the moment. I guess on the other side of the equation, people like Chen Zhao saying that, you know, he felt that Star, which is the kind of the other buzzword that's in the market at the moment, that's the neutral real interest rate, that Star actually hasn't changed that much. You know, the Fed would have said it's about 0.5% or something like that, 0 to 0.5. Now, obviously, if that's the case, real interest rates now are up to 2%. So that means monetary policy is tight. So you should expect to see a slowdown in the economy. Whereas if Star has crept up a bit, then monetary policy isn't as tight. So nobody knows. Economists can speculate around it. Chen's view was that basically he thought nothing structurally had changed. Okay, we've had COVID, but really in terms of looking at the supply of savings versus the investment demand for funds, that there's still a surplus of savings. That's fair. That's one viewpoint. I'm a bit skeptical of that myself, but I think if you think about the investment that will be needed for the greening of the global economy, etc., now you can debate will that happen or not. But I think my view is it will do, and I think we've grown more accustomed to government spending and bailouts and checks and that we will see more public spending over time. So that would be another source of investment demand. So yeah, there are different viewpoints, and equally, going back to the conversation we had, David Rosenberg was of the view that we will start to see a shift back towards austerity. But again, politically, hard to know if that's the case. We've obviously had a period in the US, particularly when Biden came in initially, where you had the ability to initiate policy. Very unusual that you had, the presidency, the House, Congress, in its entirety. Once we get past the next election, we could be back to stalemate, and it could be back to a different set of policies. But this whole debate about Star, it is key to this. But yeah, it's like it's like the old joke about economists. You put so many into a room, and you get all the different viewpoints, isn't it?
Indeed. Now let's pivot a little bit and bring it closer to what we normally like to talk about, which is trading, investing, and stuff like that. Because, well, partly, I guess, inspired by a paper from Aspect Capital on FX, but also you could say in line with what we just talked about and all the big sort of changes we see in the global economy, and perhaps the fact that a lot of countries are starting to kind of be a little bit out of sync with each other now from an economic point of view. One sector that has been really difficult for trend followers to deal with in the last 15 years, except maybe for the last year or so, has been foreign exchange. It's a big sector. It's a very liquid sector. In fact, there used to be a lot of FX-only funds, which we'll probably talk about as well. But Aspect came out with a paper that you highlighted to me. And since I know you worked in the FX markets, perhaps you can give us a sense how the FX markets, the trading of FX markets have evolved over the years from a macro perspective, and then we take it from there.
Yeah, no, the paper is about that Aspects paper is the currency phoenix. So it's about how, the reemergence of FX trading as a positive source of returns, and they split it up into periods kind of prior to 2008, 1990 to 2008, 2008 to 2021, and since 2022. And yeah, I mean, I think it's useful to give a little bit of context on the macro backdrop. If you go back to the 1960s, it was Bretton Woods. The dollar was the anchor. Currencies were pegged. And then in 1971, Nixon let dollar float, and the system currencies went to floating exchange rates. Now, for a lot of that period, there was still capital controls in place, and currencies weren't completely convertible. But as we went into late 70s and into the 80s, that became less the case, and you had the growth of the major financial centers like London. So you had much more free financial flows. And back in those days, obviously, we're all focused on Paul Volcker and his tightening cycle in 1980s, late 70s, early 80s, and that inspired a big dollar rally. So the 1980s was a period of big volatility in currencies. You had the dollar rally that was ultimately reversed by the Plaza Accord, and then a big dollar sell-off, and had the Louvre Accord. And then as you went into the 1990s, that continued up to a point in the early 1990s. You'll remember, Neil, so we were in the markets. You had the exchange rate mechanism in Europe and periodic blow-ups of that, and then convergence trades, and a lot of opportunities. And obviously you could trade not just the dollar against the Deutschmark, but you had all the European crosses, like used to be called Mark Paris as the mark against the French franc, and all of this. So there was a lot more opportunity in currency trading from the number of opportunities, but also, from a macro perspective, because you had German unification and Germany raised interest rates, and that didn't suit the rest of Europe. So that tended to leave a lot of tension within the system. So a lot of volatility. So that was a good period in terms of the opportunity set for FX traders. And then we got to the global financial crisis and into the post-financial crisis era. And then obviously what we saw is interest rates around the world all converged to zero. So a lot of the people who, investors and traders in the markets used to use interest rates as a key signal in their models for trading. But basically rates everywhere converged on zero. We had very little volatility in GDP. It was kind of a synchronized economic cycle. All the economies expanded or contracted pretty much at the same time. No great divergences across the economic cycle, and low volatility in interest rates and inflation and in GDP. So not a lot going on, and obviously not much in terms of carry to generate either. And obviously in that period as well, whereas back in the 1990s, you had a lot of cross currencies to trade. The euro came in 1999, so that took away all of that. So generally speaking, currency trading has got more difficult, I would say. But since then, the last few years, it's kind of been back to the future, or back to the good old days. We've seen obviously bigger swings in currencies. Obviously, dollar yen last year, a big move up and then a reversal. What's behind that? Obviously, the reemergence of carry as a driver. So Japan keeping rates close to zero, negative actually, I suppose, at the short end. US rates up to 5.5%. So big carry force there. More divergences in the economic cycle. Stronger growth in the US, much weaker growth in China. Investor flows as a key driver, and much more macro uncertainty and interest rate uncertainty. And obviously, I think from a kind of a trading perspective, you touched on it as well. There used to be a lot more dedicated currency traders. So Barclay Hedge has an FX trader index. It was up 9% last year. That was its best year since 2003. And the 5-year annualized return is ticked up to its highest level in a couple of decades as well. But they also published a number of programs in the index, and there's now 31 currency programs in the index. But if you go back to 2008, there was 145 currency programs in the index. So people maybe new to the CTA space might know that actually there used to be a lot more distinct currency traders, and there used to be a lot more currency traders in banks as well. Obviously, the other upshot of the global financial crisis was, Dodd-Frank, and a lot of prop desks were dissolved, and prop desks in banks historically used to trade currencies very heavily. So all of those themes are very much consistent with what Aspect point out in their paper. And basically what they do, as I say, is they split their data between 1990 to 2008, 2008 to 2021, and then since 2022. And they look at the performance of carry trades and momentum strategies in those periods. And what it shows is that, prior in that 1990 to 2008 period, you saw very positive performance around momentum and carry. The zero interest rate period, very negative, and we've seen a very strong period of performance again since 2022, particularly for momentum, but also for carry as well. And then they show, in terms of those key drivers, interest rates, GDP dispersion, inflation distribution, central bank uncertainty. They have various ways of quantifying that, and they're showing that on each of those that we're seeing a stronger market backdrop, and that's reflected in the 1 year performance of these. And also they look at the success rate of the strategies as well. The percentage of markets with a 2-sharp over a rolling 1 year basis has increased. So what's going on? I think we've had a confluence of factors here. We're seeing a better macro environment, which is conducive to currency trading. We're also seeing probably fewer managers in the space. So I think that's interesting as well. So the opportunity set is probably better, fewer traders, and all of those things combined is seeing better opportunities. And that's obviously not just for specialists in the space, but for as you say, CTAs more generally. If you go back to the winter for CTAs, or the lost decade, whatever you call it, probably the two sectors that was most challenging, I would say, were commodities and currencies in that period. And we're seeing, obviously we've had better moves in commodities, but we're also seeing better opportunities in currencies, which is obviously, helpful for CTAs. But also it'll be interesting to see, will this see more managers maybe coming back as dedicated FX traders as well?
Yeah, no, absolutely. I think that is actually quite interesting to see whether it will spark a new wave of currency managers. That leads me to another discussion, which I'll bring up in a second. Before I do that, just 2 comments. I actually do remember the breakup of the ERM, specifically because back then, as a young 20-something, I remember being asked to come on Danish television on the day it was announced that there was a breakup, and I'm not sure I was the best qualified for doing it, but it is something that stuck in my mind, having to do it. But anyways, what I would say about the Aspect paper, what I love about it is the visual that they have, where they show these 3 periods, and where you can so clearly see visually how narrow the inflation range were in that period from 2009 to 2021, which of course that they called the SERP period. And I think this is something that I think we as managers, trend followers in particular, have argued that it was an unusual period. And I am of the belief that when we look back at this period, we will conclude that was the odd one out, even though back then people called it the new normal and thought that's how it's going to be in the future. But I just don't subscribe to that. So yeah, now finally, because you mentioned this, it'll be interesting whether there will be a new sort of a breed of specialist managers, in this case in the foreign exchange markets. I don't know if you caught wind of the TransTrend paper that Nick and I discussed last week. But actually here in that, Harold does talk about whether you need specialists to trade markets or whether you should just leave it in the hands of a rules-based trend follower to do it for you. So I don't know if you caught that.
I didn't, but it is something I was thinking about in this context as well. And I mean, investing in saying with respect to FX, investing in distinct FX managers was something that was, I don't know if I'd say popular, but certainly reasonably common. So it might seem unusual now just to be an FX specialist when you can trade across macro, but I guess you did tend to have a lot of people coming out of banks who and they naturally had that FX background. And then secondly, from an investor perspective, often banks or asset managers or corporates naturally have FX exposure. And then they have that question of will they hedge it or will they do a currency overlay? And then if you kind of go into the currency overlay, then you're naturally kind of immediately taking on some level of currency risk. So it's an easy step to make to taking on maybe a currency program as part of your portfolio. I think in general, like why you have specialists, it's an interesting one. You obviously have specialists in the commodity space as well. I guess obviously they bring intimate knowledge of the sector, whereas with trend following, diversified trend following, you're not getting any unique insights on individual markets. The insight is that markets trend over time, and you apply it to lots of markets. So I think it's a different skill set by allocating to a specialist. And also, for whatever reason, you might have the view that asset class is particularly attractive at the moment. So if you felt that we're going to see more volatility in currencies, particularly over the next number of years, it may make sense to trade or to allocate to a specialist currency manager for that reason. Or you might see, because there's been a kind of an exodus of managers in the space, that there could potentially be a better opportunity in that space. So that could be another reason for allocating to a specialist. But and equally, then obviously from kind of a multi-strat, multi-manager perspective, from the perspective of being diversified, you will always get good diversification between having diversified CTAs and some niche specialist strategies within there. So I can certainly see the case for it. Not to say one is better than the other.
Of course, the euro could break up and suddenly we'll have more currencies again. But at the moment, the trend has also been that there are sort of fewer and fewer currencies to trade anyways. So we'll see. Now, we've got a couple of other topics that I think we wanted to dive in. I think I want to, as far as I remember, I think the next one we wanted just to have a quick talk about was sort of return expectations, but do correct me if I'm wrong.
Yeah, there was also the article we saw on the Chinese market. So I don't know if you want to talk about that later.
Go ahead. That's it. Yeah, definitely. That was the Reuters article where it came out, as they call it, to highlight an exclusive story. China scrutinized quant strategies as market weakness stokes, public anchor sources say. Of course, we don't know what sources they are. But they do talk about in this article from Reuters that the Chinese Security Regulator Commission has been checking several major brokers over the past weeks about short selling activities and trading strategies of their quant clients and managers essentially that are using derivatives and data-driven computer models. And I think whether they will impose some restrictions or not. But it is kind of an interesting little topic. What did you make of it? Yeah,
I think when I saw the headline, it seemed to be a bit more dramatic, maybe than it seems at more. At once you dig into it a bit more, but particularly it does mention a couple of trend following managers there as been trading in the futures or Winton and Two Sigma. The story references. But actually, I was in touch with a contact in China around it to get his perspective, and he did point out that this is something that came up a couple of years ago as well in 2021, and tends to come up when the local equity market is performing poorly, and basically the market has been struggling the Chinese authorities have initiated various policies to support the economy and the market, and it's still been a tough market, and it is heavily retail dominated. So it does seem to be kind of looking for maybe a scapegoat for why market performance has been poor. I don't think it's necessarily going to trigger any action against futures traders in the local market at this stage, but it seems to be more directed at trying to understand who are the potential short sellers in the market more than anything else. So I'd say the headline did seem to be quite a bit more dramatic and concerning, but remains to be seen. I think it does seem to be a case of a reaction to poor equity market returns more than anything else.
Oh yeah, and this is of course nothing new to us in Europe, because we have had short selling bans as well during crises. So that's definitely the normal reaction. So as you say, maybe the headline was just there to sell some clicks. Anyways, there's another article that we may want to get into as well. But am I correct now that you wanted to just talk a little bit about the paper from Pictet? And
yeah, exactly. Yeah. So, I mean, I guess one of the things we talked about the last time was, looking at the kind of return forecasts of the various asset classes, and making the case for managed futures and trend following in the context of where kind of forward return expectations are for the major asset classes. So I was making the point that, if you took, the CAPE, which is the cyclically adjusted price earnings ratio, and derived, which is around 30, and derived, future return expectations from that for equities, I think it would be around 5.5%, something like that. But interestingly, since then, a couple of pieces came across my desk. One from Robeco, it's kind of a structural outlook on the major asset classes and return expectations. There was another one from Pictet, and then actually just yesterday or today, GMOs, they periodically report or publish 7-year asset class returns, and that was out as well. So it's kind of a more of an independent, or this is what the market is saying around where to see returns going forward. And the Robeco paper was interesting in terms of not just kind of giving return expectations, but it gives a bit of context, and equally with the Pictet paper. I mean, it was interesting reading them, the two papers. They talk a lot about the structural factors out there in the markets at the moment. So for Robeco, it's how fiscal policies present a challenge to central banks. Basically the idea at the moment, central banks are tightening, but we've got fiscal stimulus, and that there's an inherent tension between the two, and how is that going to play out? You've got the dominance of capital as a production factor has been challenged by labor. Obviously, we're seeing that in the US with the strikes at UAW at the moment, and we're seeing a structural trend back towards reshoring, and politically profit maximization. It can't be the only goal of companies, and we've got this initiation of a global minimum corporation tax. So on a lot of levels, capital maybe will be more challenged, whereas over the last decade that was all favorable. And then they also highlight the geopolitical developments between the US and China. For all of that, it seemed like a fairly kind of risky environment. The return expectations still looked reasonably positive, and equally on the Pictet side, they were looking for US equities to deliver 6% annualized going forward. So not too bad. I mean, a little bit less than the long-term returns, and in Europe 8%. They were a bit more optimistic on the outlook for bonds, but equally they were pointing to some of these structural trends as well around wages versus capital, how inflation likely to be higher over time and more volatile, how debt sustainability, as we mentioned already, is becoming more of a theme. We've got this theme towards reindustrialization. You've got shrinking labor force, and everybody points to the wild card of AI as the thing that might bail everybody out and make the world a better place and boost returns and productivity. But failing that, it looks a more challenging environment. So I mean, if you were to summarize those, I mean, Pictet at 6% for US equities. I'm trying to see. I think I don't have the Rubico one in front of me for a second, but it kind of reasonably kind of 6 to 7% from memory. On the other extreme, GMO are looking for US large cap to be negative 2.7 in real terms. Now I think they have inflation at 2.3%, so slightly negative even in nominal terms. For US equities. So even there you see a wide range in terms of the expectations for equity. So anywhere from kind of flat to plus 6-7% for US equities over time. Bonds, on the other hand, people have become obviously more positive on bonds given that yields are higher now. So notwithstanding the maybe the greater risk in terms of volatility and mark to market, the starting yield for US Treasuries at 4.5% would point to, a 4.5% to be a reasonable return expectation over the next number of years. So it's in that context that we'd have to think about, well, what's the case for allocating to diversifying strategies like managed futures and trend following. And as I said before, obviously the benefit for managed futures at the moment is obviously the higher cash rates that we're seeing. And no matter how many times you say this, it seems people don't understand it or just can't get their head around it. But actually, one article that did was an FT article recently, which did talk about the challenge for hedge funds going forward in a higher rate environment, but how CTAs would be one strategy that would benefit. But even at very modest Sharpe ratios then of maybe 0.2 or 0.3, if rates are going to be, okay, they mightn't say at 5.5, but if they say at 4% going forward over the next number of years, it doesn't take a whole lot in terms of Sharpe performance to generate returns that are comparable, at least to equities. And obviously, we know that by construction nearly that they have a low to negative correlation. So it was really a sense check on my own calculations. I was probably a little bit more pessimistic in terms of my forward expectations for US equities, maybe at kind of 5 to 6%. In the street, you've got anywhere from the more negative from GMO up to kind of 6-7%. Certainly, people are more upbeat on the outlook in emerging markets from a valuation perspective. But obviously, people then highlight that a lot of that is China, and it's a bit of a coin toss as to how that is going to play out. Whether are people happy to take that kind of China geopolitical risk? But yeah, so I mean, yes. Returns not as strong as historically, not as strong as the last 10 years would be reasonable expectations. And certainly the outlook for diversified strategies looks solid in that context, I would say.
Yeah, I thought actually the FT article was interesting because, again, as you said, can be hard for people to quite understand why it benefits people like trend followers so much that we actually have a reasonable positive real interest rate or maybe a nominal interest rate. So, I mean, the beauty, of course, is that if you're a trend follower or CTA and you've structured your product well in a UCITS format or in an offshore or onshore format, then all the free cash, somewhere between 70 to 90% of the money invested, should be earning nowadays north of 5% in dollar terms, and that's obviously goes straight to the investors. So that is very important, of course. Now, one thing I don't know about you, Alan, but I don't know enough about these multi-strategy funds, but it did come up a couple of weeks ago when I spoke with Andrew. And his view was that in those kind of strategies where perhaps they use a lot of leverage to have all these small kind of pots of teams managing the money so that the overall leverage probably is quite high in notional terms. And if they trade cash products, perhaps it could be even higher. Then higher interest rates are not beneficial like it is with a trend following strategy. Do you have any insights to that argument?
Yeah. No, I was having this discussion with a client recently on the same topic, kind of discerning which strategies would do better, and obviously kind of strategies where you have to pay a funding cost, say for either borrowing or for borrowing a security to short sell. All of those pressures in terms of the higher rate environment would be felt. I think it's probably true that a lot of the multi-strats, as I mentioned at the outset, do run highly leveraged strategies. So in terms of the basis trade, but that is more getting the leverage via the futures, because you're long cash and then short the futures that way. But in general, I think it is a point that people are looking at now more closely, that it will be a point of differentiation across the hedge fund space and the multi-mat strategy space, that if you do have to borrow securities in the same way as you have to borrow cash, there's a cost associated with that, and that cost is going up.
Every time I see bonds behave like they have again this week, I am reminded, Alan, about our conversation with Roy Niederhofer about whether CTAs could make money from a rising interest rate environment. So if people don't know what I'm referring to, they should go and listen to that conversation, which was great. Roy is a great guest. Now, the last topic on our agenda for today, I have very much been looking forward to, because you have been traveling a bit and you've gone to these fancy events, one of them in Paris. And I don't know how many times I've mentioned SocGen on the podcast, but I did not get an invite to this event, despite all my free advertising I give them every week. But you did get an invite, which was great. And I'm really curious to know what are the topics that people are talking about? What are their concerns? What are they optimistic about? So if you can share a little bit of the insights, that would be super interesting.
Yeah, it was obviously primarily a manager event, but there was an investor panel where it was interesting just to get a sense of what investors were thinking, and then obviously from kind of speaking to investors at the event, certain themes emerged, and also a couple of interesting things on the manager side, at least one which I'll come back to. But I mean, I would say from the investor side, what the allocators and investors and people working, consultants as well, working with investors were highlighting is certainly one, this challenge for hedge funds in a higher rate environment. And I think this is the fact that we've gone from 0 to 5.5% in the US very quickly, and we're still seeing people adjust to that in terms of, as we've talked about before, if you went back 2-3 years ago and made a case for diversification, it was very much around, well, bond substitutes. Why would you hold bonds when the yield is so low and you've got this duration risk when you could invest in something like trend following or managed futures, which can give you diversification and you don't have that inherent risk. Now we're into a different environment. People can see the attraction of fixed income, for many kind of traditional investors. So hedge funds that were maybe relatively low vol but low return, if they're not able to generate returns in a higher rate environment, suddenly become less attractive relative to fixed income products. So that's certainly emerging as an important theme, and it was very much the same as in that FT article that the allocators and multi-strats and multi-managers and real money investors are kind of giving that feedback to many hedge funds that if there's no point in taking that risk if the returns are not going to be kind of any better than you would get in traditional markets. So the challenge of generating returns, and then secondly, obviously the competition from fixed income. And I'm sure that's something you feel as somebody representing a managed futures strategy and trend following strategy. Obviously yields have backed up, so that becomes more interesting for people who maybe have a natural bias to invest in traditional assets, and obviously not just treasuries but T-bills, but also then credit is a little bit above that. Now you can debate how diversifying all of these will be in the event of a significant downturn in markets, maybe not. But certainly, I think that competition from fixed income is definitely real. A third theme was just in terms of emerging managers and a kind of a scarcity or certainly lower levels of emerging managers launching new programs given the rise of the platforms. Obviously, if it is harder to start in business now as a small hedge fund or CTA, and often talent is being hoovered up by the large platforms on more favorable, on favorable terms to people that make it difficult for them to start off by themselves. But if you are an allocator who's looking for kind of emerging talent, that is a factor making it more challenging. Fees is back, seems to be back as a topic again, particularly around performance fees and in relation to high water marks and whether performance fees are after interest, etc. And then, interestingly, there was still comments about some clients being unwilling to go back into managed features even after the good performance because of the scars of the past are still there. So I was kind of curious to hear that even after a strong run that we've seen in the last few years, some people still have memories of the more difficult time. So they, I'd say, were kind of the main themes from an investor perspective. On the manager side, one of the things that I would say is that on the volatility side, it was just notable how I won't go into the details, but the dispersion trade has really become something that's become very popular in that space. So this is basically looking at trading the volatility of single stocks versus the volatility of the index. So your long single stock volatility, short index volatility. It proved to be a fantastic trade in 2022. And unsurprisingly, lots of people are talking about it as a great source of opportunity. It is diversifying relative to traditional assets, but it's just interesting how it wasn't something that you heard a whole lot about, but suddenly a lot of managers are emphasizing as a great source of opportunity. So there were some of the key takeaways.
Yeah, I mean, great insights. I think from the investor side, which of course I'm keenly interested in, I don't think those topics necessarily are new. Although I will say I'm kind of surprised that we still have to kind of defend our industry and that people will say, oh, I'm not going to go back to that asset class because I had a bad experience. As if it's the industry that's the problem. I mean, sometimes it's also the way people select and how long time they actually give the investment to play out. And I can't imagine that a lot of people would say, well, I'm never going to touch a bond just because last year was a disaster for fixed income investments. But then that's the reality we live in. On my personal level, you said whether I come across this argument about bonds and the competition, I would say yes. But I think when you take the time to actually explain them what we talked about earlier, that they're not really giving up anything. And if yields go down, that's going to benefit them from being, from the fixed income side or the cash management side of the funds they invest in. I think most people realize that, and so I haven't seen, on our side at least, people leaving just because of bond yields going higher. But I think from our conversations on the podcast for quite a long time now, there is this hope, bias, desire to buy the bonds, so to speak, and people that I respect a lot, kind of global macro type people, boy, have they been wrong in their timing. And just like CTAs were quote unquote dumb enough to just stay long when bond yields went to zero and below zero in Europe, we're dumb enough just to stay short as long as prices move down, and not having been tempted to buy into this incredibly downtrend in price that we've seen and continue to see. Of course, at some point it will change, and so will we. Anyways, Alan, I think this was a wonderful conversation. Really appreciate all the preparations you've done. Another thing I want to just acknowledge, Alan, with you is that you're going to allow me to take a little bit of holiday coming up soon without bringing a microphone on the road, because you kindly agreed to sit in and host the Systematic Investor series starting in early October and for 3 weeks. So first of all, thank you for doing that. I think the audience will be super excited about it. Of course, you have some of our resident co-hosts on the lined up for the conversations. I will be listening keenly to see where you take the topics and the conversations. But I really do appreciate that, because it is, although I've done it for a long time, traveling and recording over the weekends from a hotel room somewhere, I think nowadays the pressures are a little bit more that we want to sort of keep the quality high, and therefore it's in much safer hands with you. So I appreciate that.
Yeah, absolutely. No, looking forward to it. Be interesting to get the co-host perspective, but no, it should be a lot of fun.
Absolutely. And of course, when I come back, I will expect viewerships and listenerships to be sky high and you know, from all the great content that you're going to produce. Now, if you enjoy these conversations, as usual, you should go to your favorite podcast app and leave a rating and review, because they do help a lot for more people to discover the podcast. And I will say, because I, of course, know the guests that are coming up in the next few weeks, they are super interesting, and not necessarily guests that you find on all the podcast circuits. So I think you will enjoy that. Next week, before I leave, I am joined by Mark. And if you have any questions for Mark, you should email them to info@toptradersunplugged.com, and I'll do my best to get him to answer you when we record next Saturday. That's it from Alan and me. Thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.